Okay, so here we are again. This will be the final video lecture on the work of John Stuart Mill. As I've mentioned a few times, this is not, this is the fourth video, right? But this is not meant to be a definitive set of lectures on the work of John Stuart Mill. Instead, what I've attempted to do in these short videos is to hit on some of the most significant contributions of Mill, and also to touch upon the topics that were significant in Mill's time, but also that have some pertinence to today's economics. Because, of course, what we're trying to do by studying the history of economic ideas is to become better economists here in the 21st century. So, with that in mind, today I'd like to work through the last sort of controversy of the era that of course has pertinence today. And that is the distinction between the so-called currency and banking schools that existed within economics in the mid-19th century. Yep, my cat is very excited about this lecture. He's decided that he's going to start asking questions right off the bat. Okay, so let's hop into that. So in this, we're thinking about really money as an institution. How should money be organized? How do we manage the money supply? Keep in mind, this is a couple generations since Adam Smith. Economics has become a field of study. There are this time professors of economics. There are classes in economics. There's a job title, economist, right? And so the level of sophistication has gotten much greater, in just a couple generations. And so now we're talking really about the idea that there's a money out there, a thing called money, right? And that it can be managed, right? That it's not sort of something like the wind or the weather that's unmanageable. So let's take a look. Let's keep a look going here. Okay. So I mentioned a moment ago the so-called currency school and then the banking school. Okay. The centers of the arguments is really the management of currency and does currency need to be managed? Of course, in our modern economy, the answer is quite clearly yes. Central banks generally, that's one of their main jobs is to manage the currency in such a way that unemployment is minimized while prices are stabilized. This is so-called dual mandate of the Fed in the case of the United States. Of course, there are also aspects of the U.S. Treasury whose task is to manage the currency, right? So there are actually multiple organizations whose job it is to manage the currency with a variety of specializations within that. So going back here 180 years roughly, we sort of have the beginnings of thinking about monetary policy. All right, so the first of these, as I mentioned, is the currency school, and this is the one that will look more familiar to most of you because it looks sort of more like a little more like how we manage currency today, and a little more like how central banks work today. Now, the origins of this are a generation prior to this with David Ricardo, and the idea here is that currency issuance should vary directly with the underlying commodity to stabilize the value of the currency relative to goods and services. So, for example, here, if you have a gold-based monetary system, then if a nation has more gold, it should issue more currency. If it's for some reason has less gold, either, for whatever reason, then it should have less currency. And in that way, the thinking was that the price of the currency in terms of goods and services will also be stabilized, right? So if the quantity of currency relative to the quantity of whatever the underlying commodity is stabilized, then the price of the currency in terms of various goods and services should be stabilized. The thinking runs very similar to 20th century monetarist arguments, Milton Friedman stuff, that if the economy is growing at, say, 3%, and we want to stabilize prices, that we should grow the money supply at 3%. Right? In other words, the money in circulation should be adjusted in such a way to maintain a given price level. All right, this is so that you're right now you're probably thinking like, well, yeah, I've heard that stuff before. Yes. Okay. The counter argument to this is the so-called banking school, and the banking school folks make the argument that it's really impossible for a central bank to ever issue the wrong amount. Well, I shouldn't say the wrong. It's impossible for them to ever issue too much currency, and they can issue too little, but if they do, the matter will resolve itself. So we can already see that the currency school places a high value on an activist central bank or monetary authority in order to stabilize prices, where the banking school places much less emphasis on a central bank and monetary policy to stabilize the level of output and prices. Okay. So let's see, sort of how that goes, right? So how does that work? I'm gonna move my mic here. It's perennially in the wrong place. Okay, the banking school relies upon an idea known as the real bills doctrine. And here we have a little cartoon. I Google searched real bills doctrine and images the other day, and this is one of the images that came up. So this is all right. So this is one of the images that came up, right? So it's these three Lego stormtroopers beating a dead horse, and the dead horse says in their real bills doctrine. Okay, now the three stormtroopers have labels on their helmets, right? And they're economists, right? Wicksell, Newt Wicksell, Mintz, Lloyd Mintz, White, Harry Dexter White. So they're three 20th century economists, actually of a couple different generations there. Lloyd Mintz being the youngest. But I like this because it comes from a recent blog, right? And so it shows, obviously this blogger was not a fan of the real bills doctrine, but he's arguing with other people who are, right, in just the last few years, and they're arguing about the role of monetary policy. So it sort of shows you that this is still sort of up in the air. Now the real bills doctrine goes like this, right? It says that banks loans outstanding represent goods in process. All right, so what does that mean? Well, let's say if we have an economy that only has one bank, and let's just take a round number that has $100,000 in loans outstanding. Well, the real bills doctrine is the idea that $100,000 is representative of $100,000 worth of actually stuff in the economy. In other words, those bills represent real stuff. Now you might say, well, what would it look like if they didn't? Well, if they were purely speculative, right? If the values had nothing to do with what's going on in the real economy of the loans outstanding. Okay, so it's clear what. Okay, then you might be thinking, well, geez, doesn't that imply that sort of, banks are all doing the right thing and that they're making the right loans and not the wrong loans? I mean, surely the financial crisis would put that notion to rest, right? Well, in fact, it doesn't require that, right? So it doesn't require that to be the case. And here's why. It's based upon a second underlying idea, right? So you've got the banking school based upon real bills doctrine, which in turn is based upon this idea of the law of reflux. Unfortunate name for sure. I'll explain it in just a minute. But what the law of reflux gets us is that the real bills doctrine is an equilibrium theory of sorts, not really of the sort we'd think of in microeconomics, but in the macroeconomic sense, yes. In other words, if it's not there, something will push it to there, right? So the real bills folks say even if it isn't the case that banks are doing this, the law of reflux will push it to be so. Okay, so what's the law of reflux? The law of reflux is the idea that if a bank were to extend excessive loans, that any excessive amounts of those would simply be returned to the financial system in the form of debt cancellation. Okay, so listen to that again if you need to. I'm not going to say it again, but let's give an example of what that might look like. Let's say that I'm a bank and I lent you $50,000. You say, I don't need $50,000. Okay, fine, don't worry about it. I still lent you $50,000. Maybe you take $30,000, you buy yourself a car that you wanted to get, you take another $6,000, $7,000, you pay off your tuition for this year, and then you got 10 grand left over. Okay. Well, maybe you take that last 10 grand and you pay down your student debt from previous semesters. Okay. So the excess issuance that wasn't used to purchase things, real things in the current economy, was used to pay down debt. Okay, and of course, anytime debt is paid down or paid off, credit is canceled, right? And effectively, money is canceled as well. That's a story for another day. Okay, but certainly, if you don't understand how when banks make loans, it creates credits, and when people repay loans, it destroys credit, please review. Well, I have a nice video from my 104 class on banking and credit creation, so might take a look at that. So in this way, if there was ever an overissuance of debt, the law of reflux would ensure that overissuance would cancel itself out through debt cancellation. All right. So that's sort of the story of how a bank can't overissue credit. Okay, what can they underissue, right? Can there be not enough money in the economy or spending power in the economy? Banking school folks argue that, yeah, there can in a very short term, but what will happen is that other monies will fill in the gap. Okay, so over here I have this picture, and there's actually a few what are so-called near monies in here, right? Central Railroad and Banking Company of Georgia. So that's obviously not the Central Bank of the United States. It's not even a normal, it's not any government entity at all, right? It's nothing to do with the state of Georgia, except for it was probably located there. It's a railroad company for sure. Okay, and so what they are probably doing there is for whatever reason they could not receive U.S. dollars or didn't have U.S. dollars, and so they're probably paying their employers, or perhaps suppliers in their own script. In other words, they're making up their own money. And this is essentially what the banking school argues will happen in the event that a central bank doesn't supply a sufficient amount of money to fuel desired economic activity. Is that people will just start making their own monies to substitute. Okay, and if that sounds a little far-fetched, one, there's a picture there. This, in fact, was pretty commonplace in the middle 19th century. And then think the last time you used, store credit to buy something, or you used a gift card, or you used, for that matter, even a bank-issued credit card to buy something. In all those cases, you're sort of working around the U.S. dollar. So that's the argument for can't issue too much, can't issue too little. So now that we have some, working understanding of the sort of banking school's approach, we can start putting these two ideas together and sort of comparing them in a very simple framework that we call the equation of exchange. So equation of exchange, which we've discussed in previous videos. It's a big day for interruptions. The equation of exchange, which we've discussed in previous videos, is a very old economic idea, at least 500 years old. It's a truism, right? It's not something that we define as being true. That's the idea: M times V equals P times Q, or M, the money supply, times its velocity, the number of times it changes hands. Okay, so like if you put a name on a dollar bill and then log each time, like it says, it goes from me to another person, velocity is 3. Okay, it goes from me to another person to another person to another person to another person in a given period of time. It's 5. All right. So M, the money supply, times its velocity has to equal the price level times the Q, the real output of the economy. So if we have an economy that produces 10 items, its money supply is 5 okay, velocity is 1, let's just say to keep it simple, then the price of things have to be 2, okay? Oh, excuse me. 50 cents. 5 times 1 has to equal 0.5 times 10, right? Yeah, there we go. Okay. All right. Now, in the mid-20th century, so 100 years after this, of course, discussion is still continuing, right? In fact, as I mentioned, Ricardo was really the originator of the currency school, and Mill, along with several others, was one of the early advocates of the banking school. Okay. For most of the subsequent years, so particularly the earlier years of the 20th century, the banking school, in fact, more dominated. And it's around the mid-20th century that it sort of flips to more currency school and Ricardian style stuff. And now today, again, we're sort of in a bit of a battle about it. So it's something that's gone back and forth a few times, right? So in the mid-20th century, to return where I was a moment ago, now very famous economist Milton Friedman, his dad already passed away many years ago now, but he had left a big mark on the 20th century, particularly the latter half of economics. He simplified down or made some additional assumptions associated with the equation of exchange to really rebuild Ricardo's currency school. And so he made the argument that Q is relatively constant at full employment, that V would be institutionally stable, and that therefore changes in P correspond to changes in M cause changes in P. Okay, so that if M were to increase by 100%, then at some period of time in the future, prices would double. Okay, and that's very much the idea that you learned, in your econ. Well, unless you took my class, in your Econ 104 class, where it said something like, well, the long-run aggregate supply is vertical. And so therefore, if you stimulate demand to be on full employment, all that happens is that you get pure inflation, right? Now, that's a great story, right? And it makes a lot of sense. And of course, there's truth to it, too. But ask yourself, how is it that we go from increasing the money supply to prices going up? I mean, so last week the Fed decided to maintain interest rates, target rate at basically 0. Did all the stores go out and say, well, they're also pumping a bunch of money into the economy, raise the prices on all the things on the shelves? No, of course that didn't happen, right? So the transmission mechanism has to be more complicated than simply there's more money and then you get higher prices. The story goes something like this, in sort of more modern Ricardian style thinking. It says that, well, what happens is that businesses notice that nominal wealth is increasing more quickly than real output, and so then they expect prices to go up in the future and start raising prices accordingly. Right, so they start building it into contracts, things like that. Future expectations about revenues, so on and so forth. Okay, and in this way, price increases become institutionalized through an understanding that there's more money in the economic system, and so therefore delta M, or changes in M, bring about changes in P. Okay, the story from the more modern banking school goes something like this. It says, well, what actually happens is that for whatever reason there's more demand for transactions than there was before, right? So you might say, well, for whatever reason. Okay, well, it could just be that, we just got a cure for COVID or something like that. And so suddenly everybody's going to go out to the theater and start buying stuff and maybe buy new cars or buy whatever, right? So some exogenous factor leads to a demand for more transactions. And as a consequence, people need more money to facilitate those transactions. They're not just consumer transactions, but also business transactions. Businesses are placing more orders, so on and so forth. And so they need more money to do that. What the banking school says is then that the central bank is forced to facilitate that. and raises the money supply as a consequence of demand for greater amounts of liquidity, greater amounts of money. Okay? And so therefore what it is that various institutional forces pull prices up first, and then central banks, as well as the financial system in general, are forced to accommodate. Okay? So for everything is dramatic to the central bank being accommodative to also simple banks making more loans. So more business people are walking in the door saying, like, I want to expand my line of credit because I'm going to bring this new product line in, or I'm going to build this new factory, I'm going to train my employees, whatever, right? The banker's like, yeah, it looks good, looks like it's going to make money, extends a loan, credit is created. Okay. So the first story of the currency school is essentially a supply side theory of money, and the banking school is essentially a demand side theory of money. And it's not to say that demand doesn't matter in the currency school and supply doesn't matter it's that in the currency school, supply of money drives demand, whereas in the banking school it's the demand for money that drives the supply. Okay, in the currency school there's obviously a need then for a not necessarily rigid but a well-structured set of policies to manage the supply of the currency. Whereas in the banking school, you could have that, but it doesn't really matter because at the end of the day, what's really going to affect prices is other forces besides what amount of money is out there. Okay. So, here's some about, if you're watching this and you're not in the class and you want a copy of the PowerPoints, just shoot me an email. The students, the class, you guys all have these. Okay, so you can read this. Today, when we look at central banking, most modern central banking looks something like a modified version of currency school stuff. So central bankers do still talk about management of the money supply in a very meaningful way. Not as rigid as it was, say, 30 years ago when central bankers used to actually target the money supply. This was the story under Paul Volcker in the United States, and then early years of Alan Greenspan. By the late 1980s, we knew that we really couldn't target the money supply, and so we started targeting things like interest rates. And then even that went away, and now the central bank will talk about targeting inflation rates, right? And so the Fed, when talking about the key interest rates, will talk about hitting their desired inflation target. And so that's a sort of very, very modified currency school position, giving some play to the sort of banking school style argument. The sort of heterodoxy of this currently, right, in the current era, because I mentioned it's flipped a few times, the modern monetary theory people, the MMT folks who've gotten a lot of press in the last 3 to 4 years, they draw much more heavily from banking school sort of ideas, right? So you'll hear them talk about how monetary policy, it really can't do much in terms of affecting the economy, prices, employment, or really any of those things. In fact, they make some arguments that actually monetary policy works in the opposite direction, right? So that when things that I'll leave that for that's getting too far afield from our work. But and there's been a lot of work done on this, right? So there's a lot of empirical work, papers that have been written supporting both. So it's not just like people saying, I feel like this is the case, and there's a lot of work to be done still, right? So this is now sort of cutting edge economics work, right, that folks are doing, one of many areas. Anyway, that's it for here. I think that's plenty long enough, and we'll see you next time. Thanks, everybody. Bye.